Today, I'm going to show you guys how to invest in the stock market as a complete beginner. I'm going to cover some investing strategies that are beginner friendly, and to top it off, I'm going to do a play-by-play of me buying a share from my online broker, so that by the end of this video, you guys will be able to buy your first shares. So let's get started. So how does it work? Essentially, a company will split the ownership of the business into equal shares, usually reaching millions at a time. And they list those shares on an exchange where investors like us can buy and sell them. And then we actually become a very small part owner of the business, known as shareholders. Essentially, there are two different kinds of investors that invest in the stock market every day. And they're known as retail investors and institutional investors. Retail or individual investors are people who invest in stocks on their own, not on behalf of a company. These stocks become part of their personal portfolio with the aim of growing it over time. Institutional investors, on the other hand, are companies that invest in the stock market on behalf of the company, where the company as a whole is the beneficiary. They often make massive investments in stocks, usually reaching millions or billions at a time. You can buy shares two different ways, either over-the-counter style or online through a registered online broker. Now, I only invest online, so I'm primarily going to be talking about online investing. When it comes to investing, there are many different strategies you can follow, but they can all be boiled down into two categories: active investing and passive investing. First, I'll talk about passive investing as it's the easiest strategy to follow, and then I'll talk a little bit about active investing. So, what is passive investing? Passive investing is an investment strategy where an investor tries to buy and hold into the general market. Passive investors try to track the general market over the long term and build wealth gradually, believing that through the highs and lows of the market always rises, and historically it always has. As you can see, over the last 100 years in the US market, through the Great Depression, the dot-com crash of the 2000s, the 2008 financial crisis, and the 2020 COVID-19 market crash, the market has always recovered to new heights. So in short, passive investors try to ride the wave of the market through the highs and lows, believing that the market will always recover and rise to new heights over the long term. The most common passive investing strategy is to buy and hold index funds, or ETFs. Buying index funds is when an investor buys a piece of a representative benchmark index, such as the S&P 500 in America and the ASX 200, or All Ordinaries here in Australia. And they do this by buying into a fund that copies the holdings and performance of the benchmark it is tracking. For instance, if we did want to invest in the S&P 500, we could buy an index fund or ETF that copies the S&P 500 from an institution like BlackRock. Now, BlackRock are a financial institution that create and manage index funds for investors, and they list them on the general stock exchange so investors like us can buy and sell them just like any other regular shares. As you can see, the holdings and performance of the index fund directly copy the benchmark it is tracking, in this case the S&P 500. Now, there are many different financial institutions that create and manage index funds and list them on the stock exchange so investors like us can buy them. But the two main ones you'll come across all the time are Vanguard and BlackRock. Both of them provide a huge variety of index funds and ETFs for us to buy. Now, when you're choosing between two different index funds or two different ETFs that track the same benchmark index, you always take a look at each fund's fees for managing the portfolio for you. For example, here in Australia, let's say you wanted to buy a piece of the S&P 500. The two main options are IVV from BlackRock and SPY from SPDR. If we take a look at the holdings from both funds, we'll see that they are almost identical with the exact same top 10 holdings. And if we take a look at the performance as well, we'll see that on average both funds average around 15% return per year. So which one do you choose? Well, if we take a look at the fees, sometimes known as management costs or the expense ratio. Now, BlackRock charge 0.04% on your investment amount, which is very, very good. And SDPR charge 0.0945%, which is also very good. In general, fees under 0.5% aren't very noticeable on your returns, but beware of funds that charge 1 to 2%, as 1 to 2% really can take a toll on your investment portfolio over time. Last thing on fees, fees are also very, very important when you're choosing a broker, which I will touch on more when I talk about brokers later on in the video. So now let's talk about active investing. Active investing is very simple in theory, but it is much more difficult in practice. Active investing is an investing strategy where you pick and choose individual stocks with the goal of beating the market over time. So passive investors try to track the market and active investors try to beat the market. So if you were an active investor in Australia trying to beat the market, then you would compare the performance of your portfolio of chosen stocks against the performance of the ASX 200. If on an annual basis the return for the ASX 200 was 10%, then your goal is to beat that 10%. And if you can do that consistently every year, then you are a successful active investor. What makes this strategy difficult is there is a lot of research that goes into picking and choosing individual stocks. You have to understand how the company operates and how it makes money. You have to be able to look through 10 plus years of financial reports, and a lot of people just don't have the time or energy to be able to do this, which is why passive investing is the best strategy for most people. I'll leave the topic of active investing with a quote from the godfather of value investing, Warren Buffett's mentor and the author of The Intelligent Investor, Benjamin Graham. He says, "Our enterprising or active buyer, of course, will desire and expect better overall results than his defensive or passive companion. But first he must make sure that his results will not be worse. It is no difficult trick to bring a great deal of energy, study and ability into Wall Street and to end up with losses instead of profits. Thus, it is most essential that the active investor start with a clear conception as to what courses of action offer reasonable chances of success and which do not." And here's a fun fact on the success of active investors across the world that supports Graham's hypothesis. Now, as we know, passive investors try to track the general market. So if the market's up 10%, you're up 10%. If the market's down 20%, you're down 20%. And then active investors are aiming to beat the market's performance. So what if I told you there was a tool or website that tracks all the active versus passive accounts to see how many active accounts are successful at beating the market? So to find this out, go to Google and type in Spiva scorecards. And then click on the first thing that comes up, so Spiva S&P Global. And then where it says Statistics and Reports, click on View Now. Now the first report we're going to look at is the US. Okay, so this is what comes up. So what do these numbers mean? So essentially what this is are the funds that performed worse than the passive benchmark, which is the S&P 500. So as you can see, we have the 1 year, the 3 year and the 5 year data. So in 1 year, 63% of active accounts underperformed the S&P 500. Over 3 years, 71% of accounts underperformed, and over 5 years, 77%, or pretty much 78% of accounts underperformed the S&P 500. And there's a trend here that seems to be happening where as time goes on, less and less funds actually beat their passive benchmarks. So over the long term, passive investing really does have it over active investing. And this isn't just in the United States as well. If we go to Australia, it's pretty much the same thing. So over the 1 year, 57% of funds underperformed the ASX 200. Over 3 years, 75% of funds underperformed, and over 5 years, 80% of active funds underperformed the ASX 200. So there's a very strong long-term trend of, as time goes on, the passive benchmarks will pretty much 8 times out of 10 beat a active fund. And the crazy thing is that a lot of active investors will sit behind a computer screen for 8 hours a day researching stocks, trying to figure out which ones are going to, be better than average. And the passive investor just rocks up every month or every 3 months and puts their money aside, and they actually outperform 80% of active funds by following this strategy. Now, I'm not saying you shouldn't active invest. If you really like researching companies and if you enjoy trying to find stocks that are better than the average, then you should definitely go for it and definitely learn more about it. I personally really enjoy researching companies and analysing if they will be good future investments. So if that sounds like you too, then don't worry, I've got you covered, as in the future approximately 75% of my content will be orientated towards active investing, so towards individual stock analysis, my research processes and fun stuff like that. So if you don't want to miss out on those videos, please smash subscribe. So as a beginner, which investing strategy should you follow? If you're new to investing, active investing sounds good, but there is a lot of time, effort, analysis and patience that goes into being a successful active investor. You need to know how to analyze a company, screen through 10 plus years of financial reports, understand fundamentals and key ratios, and then be able to do a valuation on a business. Now, I have videos coming out on all of these topics, so if you want to be an active investor, then stay tuned for those videos. Now, this strategy doesn't come from me, so the best investing strategy that you can follow as a beginner is something Warren Buffett says, and that is to invest in low-cost index funds. There are two strategies you can use to buy index funds. One, you can buy and hold a set amount one time and hold it for a very long time. Or two, you buy a set amount continuously every set time frame. The latter is known as the dollar cost averaging strategy, and it's by far the most common strategy among passive investors, partly because it's a tried and tested strategy that has been very successful for a long time. For example, if you dollar cost averaged $1,000 a month into an index fund that tracked the S&P 500 for 30 years, where through all the ups and downs of the market, so all the market crashes that we highlighted before, it averaged 9% return per year over 30 years. Now, if you invested $1,000 per month at 9% and held it for 30 years, you would net $1.6 million. And that's through passive investing, where you don't have to think about choosing individual investments or worry about what the market is doing. You can think of it like your monthly investment plan for the future and adopt Ben Graham's philosophy. He said, best of all, once you build a permanent autopilot portfolio with index funds at its heart and core, you'll be able to answer every market question with the most powerful response a passive investor can have. I don't know and I don't care. Will healthcare stocks outperform big tech this year? I don't know and I don't care. By enabling this mentality, you liberate yourself from trying to predict or forecast what the market is going to do. And that's from Ben Graham, the author of The Intelligent Investor, also known as the Investing Bible. Passive investing is a great strategy for people who don't have much time on their hands, but it's also a good strategy for people who want to learn how to active invest and they want to put their money to work while they learn. I personally always have a set amount dedicated to dollar cost averaging into index funds every month. Right now, it's currently 30% of my portfolio and I plan to keep it that way, and I plan to keep investing for a long time. Now, let's say you've made your investment plan, you have some cash set aside and you're ready to invest. Next, you will need a registered broker, or more specifically, a registered online broker. Online investment brokers aren't much different from online banks or betting agencies. You can create a free account, put in your required details, transfer the funds into the account, and you're away. Just like you can't make a legal bet without a betting agency, you can't legally own stocks without a registered broker. In Australia, some banks offer you the chance to open an investment brokerage account with them if you already have a bank account with them. Now, pretty much all brokers charge a brokerage fee when buying or selling shares, which is how they make their money. But with the massive influx of different brokers in Australia, the competition is always driving the price down, which is good for us. In Australia, brokerage fees typically range from around $10 to $30. In Australia, my personal broker is Self Wealth, and I believe they offer the cheapest brokerage fee at $9.50 per trade. And you won't be charged any extra fees for owning an account. You will only be charged when you make a trade. It's really important to take fees into consideration when choosing a brokerage, because high brokerage fees really do chip away at returns over the long term. Now, I'm not sponsored or affiliated with Self Wealth at all. I just really like their brokerage platform. So guys, it's time. I'm going to jump on the computer. I'm going to show you guys how to open your first brokerage account, and then I'm going to do a play-by-play of me buying an index fund so you can see exactly how you can buy your first share. So let's jump on. For the step-by-step guide, the broker that I'm going to use is Self Wealth. Now, why did I go with Self Wealth? Before I show you guys how to create an account and how to actually buy your first shares, I'm just going to show you guys the compare prices tab to show you guys why I think Self Wealth is the best broker in Australia. Now, as you can see, we have Self Wealth's pricing against their competitors. Now, the problem I have with a lot of other brokers is that as your trade sizes get bigger, you're going to end up paying $1,200 or $1,000 every single trade in brokerage fees. But with Self Wealth, you only pay a $9.50 fixed fee every single time, no matter what. So if you want to create an account, go to join now for free, create my free account, and then you will be asked to log in with an email and a password. From there, it will take you into an application process that will take up to 2 to 3 business days to complete. Now, you'll be asked for a lot of personal information to make sure that the person trading is actually you. And if you want to invest today or tomorrow, this isn't going to work because it will take 2 or 3 days to actually get your account up and running, because what SelfWealth do is they have to create a bank account on your behalf, and that bank account becomes your trading account, and that's the bank fund that you transfer your money from your actual bank account into this bank account to be able to purchase shares. Okay, so let's say you've created your account, you've waited a couple of days, and now your account is actually up and running. So this is the dashboard that you will see when you very first log in. Now, we have a drop down menu on the left hand side, so I'll quickly explain some of the more important ones. My portfolio is where your holdings will be stored, so that will show you all the holdings that you currently own. Stock watch list, so this is where you can create a list of either index funds or individual stocks that you wish to keep a track of. So I'm going to show you guys my watch list in a second. And then my orders, which is something that we'll take a look at in a second, is where you actually purchase the shares that you wish to buy. And then finally we have trading accounts. So this is what we're going to look at first. And from there we're going to go deposit cash. Okay guys, so before you can buy a share of anything, you need to transfer money from your normal bank account into your trading account. And SelfWealth give you 2 different ways to do this. So the first way is the direct bank transfer, where you put in their BSB and account number and you put in the amount of money you wish to transfer, and then it will usually take 1 to 3 business days, just like when you transfer to another bank account. And the other way they let you do it is through BPay. So this is the way I usually do it because it's much quicker if you want to access the funds straight away. Okay, so let's say you've deposited your cash and now you're ready to create a watch list. So we're going to click on watch list, and this is what you will see come up. So I currently have 2 different watch lists. Watch list 1 is just my list of individual stocks and companies that I'm keeping track of, and index funds is where I keep a list of different index funds that I also like to track. So right now I'm currently tracking 8 different index funds or ETFs from different parts of the world. So I'll just give you guys a brief rundown of the different stocks in my index fund watch list. So the first one we have here is an index fund from Beta Shares with the ticker symbol Asia. Now what this is the top tech companies in Asia. So big companies like Samsung, Tencent, Alibaba, big high growth tech companies. IOZ is a index fund from BlackRock, and this tracks the ASX 200. So this is an ASX 200 index fund. IVV, which is one of the ones we looked at before, is another index fund from BlackRock, but this one tracks the S&P 500. So it's an S&P 500 index fund. NDQ is an index fund from Beta Shares, which tracks the NASDAQ 100. So the big tech stocks in America, the likes of Apple, Amazon, Microsoft, all those things are in the NASDAQ 100. SPY is an index fund from SPDR, and this is another S&P 500 index fund. STW is another index fund from STBR, but this one tracks the ASX 200 as well. So I have 2 ASX 200 index funds and I have 2 S&P 500 index funds from 2 different companies, just to watch what both of them are doing and to compare fees and to compare performance and stuff like that. VAS is an index fund from Vanguard, and it stands for Vanguard Australian Shares. Now this one tracks the ASX 300 instead of 200. So instead of giving you exposure to the top 200 companies in Australia, it gives you access to the top 300 companies in Australia. And finally, the last one is VTS. Now this is an index fund from Vanguard, and it tracks the total US market. Now what that means is the S&P 500 only tracks the top 500 companies in the US by market cap, and there's obviously a lot more than 500 companies in the US. There are thousands. Now what VTS does is it gives you exposure to the top 500 companies just like in the S&P 500, but also all the other small companies that aren't included in the S&P 500. So you're getting exposure to the entire US market, so the big companies and the small companies as well. Okay guys, so we have a bunch of different index funds on our watch list, and we have hypothetically decided that the first index fund we want to buy is IVV. Now the reason is we want our exposure to the big, bright, high growing companies in the S&P 500. We know that the S&P 500 has got a really good track record over the long term for giving really good returns every year. And the reason we're going with IVV over SPY is, as we established earlier, the fees from BlackRock are much lower. So guys, let's buy our first index fund. So now we're going to go to place orders, and this is what's going to come up. Now if we already know the ticker symbol for the index fund or stock that we wish to look at, we just type that in. So we type in IVV and it's going to automatically bring up iShares S&P 500 ETF. Now this is where you want to check that you have the right fund and you're not accidentally buying shares of another fund. Okay, so the next thing we're going to look at is we're going to look at these figures over here, see what they mean. Okay, so we have two figures here, bid and offer. Now what these mean are there's a slight difference between those prices. There's around 30 cents. And this 30 cents is known as the spread, and the spread is how the market makers make their money. So if you're looking to sell shares, this is how much you will get for selling a share at the market price. And if you want to buy a share, this is the price that you will pay. So you will only pay a slight little spread more. The last price is the price that the stock closed at on its last trading day. The day low is how low the price went on a particular day, and the high is how high it went. So for this hypothetical Friday, the highest that the stock went on the Friday was 507 and the lowest it went was 500, and the price it closed at was 501. Okay, so next we're going to look at the price type. So we have a market order and a limit order. Now a market order is you putting in an order for whatever the price is at that current time. So if the price is 501.71, that's the price you'll pay for the stock. And if the price is 507, if you do a market order, that's the price you will pay. A limit order, on the other hand, is where you can set the limit for how much you are willing to pay. So we'll use these figures here. Let's just say the stock is floating between 500 and 507. So you can set a limit for 499 and your order won't be executed unless the price hits that amount. Now this is more of a tactic for active investors to try get a slightly better price when you're buying individual stocks, but as long-term passive index fund investors, we don't really care about a dollar here or a few cents here. So most of our buying, we're going to just be doing market orders. So the last thing we have is quantity versus value. Now very simply put, quantity is the amount of shares you wish to buy and value is the amount of money you wish to spend. So we know that the value of the shares are $500 a share roughly. So if we buy 2 shares, it's going to be $1,000. If we buy 3 shares, it's going to be 15. If we buy 4 shares, it's going to be 2K. And value is just where you put in the dollar amount you wish to spend. So if you have $5,000 to spend, you put in 5,000, it would give you the amount of units that you can buy for that amount when you include brokerage fees as well. So you'll end up buying 9 units for roughly 4,600, so you'll end up having a couple of hundred left over there as well. Now I prefer to just do quantity because I find it much simpler, and we'll say we're going to buy 2 shares for our first buy. So we're going to buy $1,000 worth of IVV. So we triple check that everything is correct before we hit buy. So IVV, iShares S&P 500 ETF, yes, that's the one we want. We want to buy. We want to buy a quantity of 2 shares, which will be roughly $1,000 just over. We're going to do a market order, and then the expiry is how long that order will stay in. And this really only applies to limit orders. So if you put a limit order for 490, how long will that order be in the system before it disappears? Because if the price doesn't hit 490 by the end of the day, then that order will be cancelled. But you can do a date, you know, a week from now, and if the price doesn't hit that 490 point by the week, then your order will be cancelled. However, if it does hit that price, then your order will be executed. So we're going to do day only market order for $1,000, and if you're ready to buy, you just hit review order and it will bring you up with another screen, which is basically just a confirm your order tab. So you triple check everything again, and then if you're ready to buy, you just hit confirm order and your order will be put into the system. Now the way orders work is very simple. The orders will only be executed if the market is open. Now in Australia, the market is only open between 10 AM and 4 PM Monday to Friday. So if you put your order in on a Saturday night at 11 PM, that order won't be executed until the market opens on Monday morning. So it's good practice if you're buying shares at the market price then try to put your order in when the market is open, because that way market orders when the market is open will be executed instantly. Okay guys, so that's it. You've bought your first share and now you want to look at it and you want to keep track of your portfolio. So now we're going to click on my portfolio and it's going to bring up the list of your holdings. So right now currently I have 2 index funds in this portfolio. I have the Asia one that we mentioned before and I have the NDQ. And as you can see, you have the average price for how much you paid for the share. So I own 105 shares of the Asia index fund and the average price I paid was roughly $9.94. So the profit and loss is where it will show you your percentage gain. So since I've bought this index fund, it's gone up 31%. This is the current price now for the shares. And then this is the value of how much you actually own. Now because this is my passive portfolio, I don't check this every day. If anything, I barely check it at all. I just continuously rock up every month and I keep putting my capital to work. Now over time I may or may not add different index funds to this portfolio, but right now I'm happy to just keep investing in these 2. Now guys, this is not financial advice. This is not a buy or hold or sell recommendation for any particular stock. I'm just a regular Irish millennial and I'm definitely not qualified to give you guys financial advice. This is just my opinion for entertainment purposes only. So guys, that's it. It's very simple. If you're a passive investor, you just do this same routine every month or every 6 months with the same amount of money, and you just keep turning up the dollar cost average over the long term. And as you saw earlier with the compound interest calculator, if you leave this to compound for a long time, it can absolutely generate massive returns for you guys. And you can do this with very little effort as well. And by following this strategy, you can actually outperform the majority of your active companions who are sitting there behind a computer for 8 hours a day, analyzing stocks and crunching numbers and looking through financial reports. You can actually outperform them over the long term just by turning up and dollar cost averaging into index funds. So that's it. Now you're ready to buy your first index fund. If you found this tutorial useful and if you ended up buying your first index fund, let me know down below what you guys bought. Let me know what index funds you guys are looking at. Guys, if you watched the video this far, thank you guys so much for your support. It really does mean a lot. If you found this video useful or if you learned something new, please consider subscribing and also hitting that like button, as it really helps support the channel. Thank you guys so much and I'll see you in the next one.